up where we left off. So, here's what happened on October 25th. On October 25th, we went to the mailbox, we opened the mailbox, and we had a check for $80,000 representing dividends that we earned on our investment in Santos. The $80,000 was calculated by taking the number of shares we own, which is 200,000, and multiplying times the dividend rate of 40 cents a share, gives us $80,000 total cash. So since we got cash, we're obviously going to debit cash here for $80,000. And the question is, where's the offsetting credit going to go? Now, if these were available for sale or trading securities, obviously the offsetting credit would go to dividend income. However, because we are accounting for this investment as an equity method investment, the dividends that we receive are not recognized on the income statement as dividend income, but rather are viewed as a return of capital, a negative investment, if you will. So, that $80,000 receipt of dividends is going to serve to reduce the carrying amount of our investment in the securities. So we're going to debit the asset account investment in equity method securities, the same account where we originally recorded the cost of our acquisition of securities. So again, the takeaway is, under the equity method of accounting, the receipt of dividends from the investee does not go to the income statement as income, but rather it is viewed as a reduction of capital and is used to reduce the carrying amount of the investment on our balance sheet. Okay, the last part of the wrinkle with equity method of accounting is, well, okay, if we don't recognize dividend that we receive as investment income, how do we recognize investment income under the equity method? Well, the answer to that question is, under the equity method of accounting, we recognize as investment income our proportionate share of the net income that was earned by the investee. So in this case, here we are at December 31st, we got the income statement from the investee. We looked at it, we saw that the investee had earned, according to the facts of the problem, $860,000. We know that we have a 40% stake in the investee, so our share of the investee's net income is 40% of $860,000, or $344,000. So we're going to book that $344,000 into our accounting records. The credit side of the entry goes as a credit to investment income. That investment income is going to show as a line on our income statement, just like any other line of income or revenue on the income statement. The offset to that credit, the debit of $344, is going to serve to increase the carrying amount of our investment in those securities. So we're going to debit the asset account, investment in equity method securities, for the amount of our proportionate share of the earnings that we're booking here at year end. So to provide sort of a summary, then, if you look at the investment in equity method securities T account, journal entry number 1 here, booking the acquisition of the securities, $2.6 million. Journal entry number 2 here, representing the receipt of dividends that serve to decrease the balance in the investment account. And then journal entry number 3 for $344,000. That was the journal entry that we made in order to pick up our proportionate share of the earnings in the sub, or the investee. So if you foot down the T account to determine the balance in the T account, the balance at December 31st, 2014 is $2,864,000. So what you can see is, at any given balance sheet date, if you're accounting for an investment under the equity method of accounting, the balance in this investment and equity security method account represents the original acquisition price increased by the total, by your proportionate share of earnings in the sub that you have booked since you bought your investment in the sub, reduced by the total dividends that you've received from that sub since you've owned the investment. That's what the remaining balance, or that's what the balance in the investment account under the equity method reflects.